YouTubers, Mike Martin's here, Mike Martin's channel. Guys, this is a good one. This is a very good article. Can banks survive negative rates? Now, we've been talking about negative rates for a good long time on the channel, and I think we better talk about this because with banks having no liquidity and constantly deleveraging and looking at the Fed's governments to bail them out, or the taxpayer to pay them out, to bail them out, well, stealing our fortunes and futures away, one QE at a time, well, can the bank survive negative rates? Let's find out what Zero Hedge has to say. It's our friend Tyler Durden there. The declining economic outlook, increasing political pressure are pushing central banks into more aggressive, unconventional monetary policies. Banks don't have money, that's a problem. Simultaneously, fears are growing that such steps, especially negative interest rates, actually threaten the stability of the financial system. You don't say, eh? The risk setting off dangerous feedback loops in credit markets and the real economy, where the second and third order effects are difficult to anticipate or control. Of course you can't anticipate or control anything. You don't know what the feds are up to. You don't know what the government's up to. You don't know what lawmakers are up to. It's this neoliberalism crap that's happening right now. You know what I'm saying? So it's the kind of renegotiating the rules as you go along is the problem here. As an experience of banks in Japan and Europe has illustrated, the process follows predictable pattern. Low growth, low inflation, output gaps, unemployment, and underemployment, combined with financial instability, especially volatile asset prices, first prompt central banks to lower rates below the zero bond. The objective is to stimulate borrowing to finance consumption and investment, thus setting off self-sustaining cycle growth. So you guys know the zombified banks down in Japan and trying to get this sustaining growth cycle that's basically, again, banks deleveraging and then governments putting back in, and it just doesn't in the end it doesn't add up. It makes no sense, right? Typically, however, negative rates aren't fully reflected in actual borrowing and lending rates. That's true. Regulations require banks to maintain customer deposit bases. About that. Yeah. Look up fractional reserve, guys. The fear of losing customers dissuades those banks from cutting deposit rates too far. So, remember when the bank used to give you 4.55% on your deposit? Save your money. ING, 5%. 5% on $1 million. That's $50,000 a year. There's a lot to be said by that. Europe, to date, only large corporations have faced negative rates, which means they're charged to maintain deposits. As interest rate margins contract and profits squeeze, bank raises fees or turn to other revenue measures to boost earnings. This keeps actual borrowing costs relatively high, undercutting the whole point of the negative rate policy. As the economy continues to sputter, desperate policymakers slash rates more and more deeply. Government bond yields grow increasingly negative. But not today, guys. And never mind. Yeah, government bond yields grow increasingly negative, and the yield curve flattens. Banks, which hold substantial amounts of government debt, see their profits decline even further. Weak earnings, in turn, impact banks' shares prices and rise doubts about future dividends. Very important there. That's how you keep them. That's how you keep investors calm, making sure their dividends don't get touched. Buybacks should be, and or capital returns. Weaker institutions run into funding difficulties, and deficits too. Funding difficulties. Virtually all face higher borrowing costs. This perversely reduces the amount of credit available, which again dampens the consumption and investment, given the bank payouts make up a significant source of investor income. Fears of shrinking dividends and add to the gloom instead of stimulating the economy. Negative rates increase uncertainty about the future. Households worried about saving for retirement and other goals, spend less. Well, consumer confidence is not at an all-time high. I think in Australia, and I think in parts of Canada, most of Canada actually, consumer confidence is the lowest it's been since 1975. So 74 or 75. It's actually very low. And our production, we're the weakest manufacturing and production since the Great Depression, this quarter that we're in right now, believe it or not. You don't have to believe me, but look it up. It's happening, guys. Slowing growth increases the number of non-performing loans. This further erodes bank profits and reduces lending. It also increases borrowing costs for banks, which results higher credit margins for borrowers. Negative rates distort incentives. Facing declining profits, banks grow reluctant to foreclose on distressed borrowers. They extend lifelines to zombie companies, which can service their debts when interest rates are so low, even if they have no prospects of repaying the principal. So basically, a lot of them are like on this 100-year bond we're seeing. They're stretch out this 30-year to 40-year, and then let's do this 40-year. Now let's just do interest only. Now let's see if we can go as low interest as possible because we have no way of paying this principal off. That's how zombied out we are right now, and that's what's happening, people. This is an inefficient use of capital, which reduces potential growth, which is true right here, and sets the stage for long-term economic underperformance. Struggling banks also naturally have less demand for government bonds, which restricts the ability of countries to finance their activities. In extreme cases where banks need to help to stay afloat, already heavily indebted governments must borrow to recapitalize them or guarantee deposits. Increased debt levels and rising debt service commitments lock the state into a low or negative interest rate environment. The ill effects of these trends will initially vary depending on how profitable countries' banks are, as well as their interest rate margins and the quality of their loan portfolios. European and Japanese banks face low profit margins, while a growing pile of non-performing loans are especially vulnerable. And ultimately, the problems will spread. U.S. banks have begun to lower earnings guidance, blaming lower rates. There are two primary transmission channels for negative rates between countries. As witnessed in Europe and Japan, banks face with negative rates export capital aggressively, okay, driving down returns elsewhere. Also, higher relative rates cause currencies to appreciate, forcing nations to match interest rate cuts in a race to maintain competitiveness. It is a race to the bottom from here. There are a few alternatives. Germany is examining whether to prevent banks from charging most retail clients for deposits, and other alternatives including creating special safe assets or saving accounts that guarantee positive rates. Both measure would undermine negative rate policies, of course. Another option is for central banks to lend either directly or through banks such as the European Central Bank's existing targeted longer-term refinancing operations at concessional rates. However, there may be limited demand for loans. The efficiency of these programs is the best modest. But so people are going to obviously lose faith in the banking system, and then you see a runoff. People lose faith, and this happened through rumors. People have pulled money out of their accounts because of just a mere rumor that was out in the 60s and 70s, 1960s, and then you start seeing runoffs on banks. So they have to kind of, what are they going to offer the customer basically to keep their money in a bank, right? So negative rates is not good. Negative rates is crippling. The unplanetable reality is that the world still hasn't learned the true lesson of 2008. An economic model that's dependent on consumption and investment fueled by excessive borrowing is unsustainable. Lower rates, which are ineffective and weaken the financial system and ultimately the real economy, are merely a mechanism to maintain excessive debt levels for a little longer. That's all you're doing. You're stretching it out. Just make it in layman's terms here. Really simple, okay? I can't afford this 10-year loan. Can the bank stretch it to 20-year and lower my payment by $60 a month? But I'll pay it for an extra 10 years. I can't afford this 20-year loan any longer. Do you think they could stretch it to 100 years? And then this way, yeah, I won't live long enough to pay it off, but at least I could get these minimum payments in check, and that's what's happening, and that's when things start zombiciding, and when people basically get into this cycle of unpreparedness and spending money on things they shouldn't be, and companies and corporations blowing money on the crappiest things you could ever imagine. It's like, wow, I wonder what stock investors are going to look at this when they see this come Monday morning. Yeah. An old farmer reputably advised to a lost traveler, if you want to go there, I wouldn't start from here. Policymakers missed the opportunity to make fundamental changes at the onset crisis. No wonder they now find themselves adrift. Well, they got rid of the Glass-Steagall Act and the other act there that was put into place to marginalize, for banks to be marginalized when it comes to making these risky investments and basically opening up the doors to the great bank of the casino. Yeah. It's this neoliberalism and the changing the rules or redefining the rules as they go along, as they see fit, to keep this kicking the can down the road more prevalent, I guess, or keep it going when it's got nowhere to go but down. Anyways, guys, I believe in metals. I'm a metal believer. Metals are down now. Buy on the dip. Let me know what you guys think and comment below. And no, I'm not an investment channel. Don't listen to what I'm saying. Do your own research. And knowing is half the battle.